Hello everybody. In this time we are talking about financial risk. Financial risk is the possibility of losing money on an investment or a business venture. Some more common and distinct financial risks include credit risk, liquidity risk, and operational risk. Financial risk is a type of danger that can result in the loss of capital to interested parties. This can mean that governments are unable to control monetary policy and will default on bonds or other debt issues. Corporations also face the possibility of default on debt they undertake, but they might also experience failure in an undertaking that causes a financial burden on the business. And then we move to types of financial risk. Financial risk is one of the high priority, especially high priority risk types for every business. Financial risk is caused due to market movements, and market movements can include a host of factors. Based on this, financial risk can be classified into various types such as market risk, credit risk, liquidity risk, operational risk, and legal risk. We start from the first, market risk. This type of risk arises due to the movement in prices of financial instruments. Market risk can be classified as directional risk and non-directional risk. Directional risk is caused due to movement in stock price, interest rates, and more. And non-directional risk, on the other hand, can be volatility risk. And then the second, credit risk. This type of risk arises when one fails to fulfill their obligations towards their counterparties. Credit risk can be classified into sovereign risk and settlement risk. Sovereign risk usually arises due to difficult foreign exchange policies. Settlement risk, on the other hand, arises when one party makes the payment while the other party fails to fulfill the obligations. And then the third, operational risk. Operational risk refer to the potential consequences of operational failures or discrepancies. These include risks such as management, fraud, data protection failures, security issues, and technical failures. And then fourth, reputational risk. A company's reputation can be negatively affected by ethical violations, safety or security issues, sustainability concerns, and unethical practices. And finally, fifth, liquidity risk. There are two main types of liquidity risk which can affect a business: market liquidity risk and cash flow liquidity risk. And then we move to primary causes of financial risk. Financial risk is a complex matter and various factors contribute to it. The first factors: market volatility. Rapid and unpredictable fluctuations in market prices can drastically affect the value of investment. This can quickly erode the value of personal assets and retirement funds, affecting long-term financial plans. And then second, navigating the ripple effect. These forces often interact, creating a ripple effect that can amplify financial risk. For example, an economic downturn can lead to higher unemployment, reduced consumer spending, and increased default rates, further destabilizing the financial landscape. And then the third, economic concerns. Recessions and slow business can lead to financial instability, affecting earnings and job security, reduced consumer spending, and overall economic activity can also result in lower earnings and financial strain for companies. And then fourth, internal specific events at the company. Internal issues such as management changes or product failures can lead to unexpected financial losses. Poor management of at-risk customers can also potentially increase losses. Fifth, inflation. The rising cost of goods and services can erode purchasing power and impact the actual value of investments. A rise in inflation reduces real income and the value of savings, impacting overall financial security and purchasing power. And then six, interest rate changes. Changes in interest rates can have an impact on the cost of borrowing and the returns on investments. For businesses, increases in interest rates can lead to higher borrowing costs, affecting profitability and operational expenses. And how to manage financial risk, Financial institutions use credit scores to measure an individual's or company's credit risk, and those with greater risk are likely to be penalized with higher interest when borrowing. Conversely, entities with lower financial risk can be incentivized with lower interest rates. Loan requests are also more likely to be rejected when the borrower has high credit risk. In the case of investment in companies, investors will look at several metrics in a company, including its cash flow, net profit, recurring revenue, margins, etc. They take all these elements into consideration and calculate the overall risk of investing in the business. And then the key benefits of financial risk management. Internal financial risk management within companies is equally crucial. finance managers ensure diversification in investment portfolios to lower risk factors. For effective financial risk management covers much more than just investments and should often be highly proactive rather than reactive. By using a comprehensive spend management solutions, companies and their finance teams can avoid financial loss and improve cash flow management all at once. I think it is enough for this session. Thanks for watching, and don't forget to give this channel with your like, comment, subscribe. Thank you.